Hello, and welcome to another episode of Tax Stuff You Should Know. It's a tax related podcast sponsored by the law firm of Aaron Fox Schiff. My name is Bob Pluth, and I'm joined today with my esteemed colleague, Gene Magidenko from our Ann Arbor, Michigan office. How you doing, Gene?
Doing pretty well today, Bob. How are you?
Not bad, not bad. To use a baseball analogy, I think we're in the top of the ninth inning as far as summer is concerned. It is going by way too fast, but here we are nonetheless. So today's topic, we're going to talk about liquidation of partnerships and some of the traps for the unwary that can happen in those settings. These are questions that not always, but often arise in the context of family businesses or family investment companies that maybe parents set up. And when the survivor of mom and dad is gone, invariably one of the kids might come along and say, well, gee, I'd kind of like to go my own way. Can we liquidate this entity, and what are the tax consequences of doing that? And so that's our focus for today. Gene, why don't you start us off on the technical stuff?
Of course. And, thankfully, partnerships, for instance, being probably the most common tax form of entity that we see, are not a Hotel California. So you can check out, in many cases, without, incurring much, if any, tax. But the devil's in the details, if you will. And in some cases, there are some traps for the unwary, some potential pitfalls that you want to watch out for. So, perhaps taking a step back as a technical matter, the tax consequences of a partnership liquidation are attributable to distributions to the partners in liquidation of their interests. So, from a tax perspective, the liquidation of the partnership itself doesn't cause tax to be borne by the entity. Instead, it all flows out to the partners, which is unsurprising given the partnership form. Uh, Generally speaking, where the partners pay the tax on whatever their allocable share is of partnership tax items. So, go
And
ahead,
Gene,
Bob.
when we're talking about partnerships here, just to be clear, as we always uh, need to be, uh, we're talking about LLCs as well that are taxed as partnerships.
Exactly. Yeah. And any entity type that's taxed as a partnership. Occasionally, you might even see trusts that are taxed as partnerships, business trusts, and so forth. But that's pretty rare. But yeah, but any type of entity that's taxed as a partnership for federal tax purposes.
Great.
So generally speaking, liquidating distributions to partners are similar to current distributions. Really in very many respects, except for a couple of key points. So first of all, unlike on a current distribution, the liquidating distribution actually can allow the recognition of loss to a partner in certain cases, and the transferred basis of distributed property can be increased up to the partner's outside basis in the partnership. So just as a reminder to listeners, there's two concepts of basis, if you will, with a partnership. There's the outside basis and the inside basis. The inside basis being the basis of assets in the partnership's hands, and the outside basis being the partner's basis in the partnership interest. And unsurprisingly, when you liquidate a partnership interest, whatever property the partner receives, they receive a transferred basis, potentially stepped up to whatever their outside basis is, or stepped down as well. So if for whatever reason the inside basis is higher than the outside basis, there could be an adjustment down as well. So it works both ways. But as I, perhaps taking a step back, the general rule is that there's no recognition event for the partnership itself when it's liquidating, or really when there is any type of distribution to a partner for that matter, except to the extent that there is a distribution of certain hot asset type of property, or 751 is the code section. It's oftentimes referred to as 751 property in exchange for the partner's interest in other types of property, or vice versa. So, for instance, if there's a distribution of unrealized receivables, of inventory items, those are kind of the classical categories of hot assets. But within those definitions, so it's not just, it's just not just receivables, it's not just inventory. You can have, depreciation recapture also falls within that category. That's a big one, and certain other tax items as well.
So, Gene, just as an example of unrealized receivables, if you and I were in a law partnership together, which we are, but if it were just the two of us, and we were going to dissolve the partnership, and we're cash method taxpayers, so all of our outstanding receivables are unrealized in the sense that we only pay tax on them and recognize them as income when clients pay us. If we were to have a deal where you take all of the unrealized receivables and I take all of the equipment and law books, et cetera, office furnishings and whatnot, that would be kind of a classic situation where we would have uh, uh, hot assets to worry about, because I'm not taking my 50% share of the receivables. You're not taking your 50% share of the other assets.
That's right. Exactly. It essentially has to deal with situations where you may have a reallocation, where there's not a pro rata distribution of hot assets versus other types of assets, reflecting ultimately the fact that there are different types of income associated with different types of assets. Hot assets generally result in ordinary income versus other types of assets far more likely to result in capital gain when sold.
So the idea here is that it's all about making sure that we can't manipulate who gets the ordinary income and who gets the capital gain when we're liquidating the
Exactly.
partnership. Okay, great.
Exactly. And so, likewise, when you're liquidating a partnership, there's typically no gain recognized by the partner whose interest is being liquidated, except to the extent that any money received by the partner in exchange for the partner's entire interest exceeds the partner's outside basis, including whatever the partner's share of income is for the portion of the year preceding the liquidation. For this purpose, money includes not just cash, though cash certainly would fall within that category, but also relief from partnership liabilities, as well as marketable securities received. And we'll get in a few minutes to some of the specific rules related to marketable securities, but that's definitely something to watch out for when liquidating a partnership. Additionally, if there's a distribution of, let's say, hot assets in exchange for non-hot asset property, or vice versa, as we discussed, that can also trigger gain because you're reallocating these different categories of assets from partner to partner potentially.
Great.
Again, I think it's important to reiterate that the presence of hot assets within a partnership is something that's very important to keep in mind and to manage. Again, there may be a lot of temptation to distribute certain kinds of assets out to different types of partners or different categories of partners when you're liquidating a partnership, and being mindful of kind of the subsets of assets that are going out is important, or at least understanding that there may be some tax consequences to doing so, both on a just a straight up distribution as well as a reallocation of those hot assets. In addition to hot asset issues, which are obviously important to keep in mind, I think the other big category of issues is mixing bowl transaction considerations. And typically, this will happen when you had partners who contributed property, so non-cash property, to the partnership within the preceding 7 years. And there are two companion code provisions that address mixing bowl considerations. The first requires that a partner accelerate gain or loss when property contributed by that partner to the partnership is distributed to another partner within 7 years of the original contribution, subject to a ceiling on the amount of gain, essentially limited to the built-in gain when the property was originally contributed to the partnership. What this helps to facilitate is a more fair recognition of income, and also preventing the essentially non-recognition transfer of assets between partners, because early on it was recognized, given the pretty favorable contribution and distribution provisions from partnerships, that you do have the potential for exchanging assets without recognizing income. And so the mixing bowl rules really get at these types of transactions. Obviously, aside from the general rule, there are certain exceptions. So if you have structural changes to the partnership, let's say a partnership merger, division, incorporation, the mixing bowl rules will not necessarily apply. On the other hand, there's also an anti-abuse rule that allows the IRS even to step outside the kind of discrete bounds of the mixing bowl transaction rules if there is some sort of an abusive purpose to a transaction, or some sort of a transaction that tries to avoid the application of the mixing bowl rules.
So, Gene, just a quick example. Let's say mom and son form MS partnership. Mom contributes cash of 1,000. Son contributes a piece of real estate, Blackacre, having a value of 1,000. But son's basis in that land is only 400. That's what he paid for it, let's assume. So there's a built-in gain of $600 attributable to son's contribution of Blackacre to the partnership. He can make that contribution on a tax-deferred basis, but the bedrock rule here on these mixing bowl rules that you're going to go into in even a bit more detail is that son is going to have to pay the piper one way or the other on that $600 of gain. We can't transfer it to mom. Son can't walk away from it. That's kind of a fundamental rule that follows us throughout all of these partnership rules in subchapter K of the code.
That's right. Yeah, it's again just a lot of potential traps there for the unwary, but uh, typically, tax advisors do keep them in mind. So, a good case in point for why it's helpful to engage a tax advisor as opposed to trying to fill out your partnership tax return by hand, right, Bob?
There you go. Absolutely.
Uh, so the mixing bowl rule I just mentioned is relating to the recognition of gain by a partner when property contributed by that partner to the partnership is distributed to someone else within 7 years of contribution. There's a companion rule under Section 737 of the code that requires a partner to recognize unrealized pre-contribution gain, again, the built-in gain, when appreciated property contributed by the partner is retained by the partnership and other property is distributed to the partner. So basically, when contributed property is sent out to another partner, that can result in gain. Likewise, if a partner contributed appreciated property and then they in turn get other property, non-cash property, that can also trigger these mixing bowl rules. And this companion rule also has a similar 7 year limitation.
So in my simple example, if we were to terminate MS partnership, mom and son partnership, and son gets mom's uh, $100 in cash, and mom gets the property, gets Blackacre, uh, clearly that's something that these rules uh, aren't going to allow free of tax. Now, interestingly, in that case, son's going to have gain in any event because he's going to have more cash than he has basis. Uh, he's getting $1,000 of cash as opposed to $400 a basis, and the rules are always going to catch them in that regard. The better example might be if, down the road, when there are multiple assets, if they want to make $1,000 distribution to the partners, and mom takes the property that son contributed, Blackacre, and son takes another piece of property, Whiteacre, that maybe they bought with mom's $1,000. These mixing bowl rules would catch that transaction as well. So,
That's right.
so I guess it's fair to say that if somebody is considering taking a partnership apart, liquidating a partnership, one of the first questions we would ask is, has any partner uh, contributed appreciated property to the partnership throughout its history? If so, when? And if so, who did? On the other hand, if, as is the case in many partnerships, if the partners initially contributed cash and the partnership goes out and buys property that it owns for the first time, we don't have to worry about these rules, correct?
That's right. Yeah.
Okay.
So someone who contributed cash doesn't have to worry about the mixing bowl rules. It's really when you're contributing property and appreciated property to be precise.
And if the 7 year rule has run, if 7 year period, I should say, has run, even if there were contributions, then we're outside of these particular concerns when we distribute in kind to the partners themselves.
Generally speaking, yes, unless there's some sort of anti-abuse angle there that the IRS could lean on if, seven, come the first day after 7 years and all of a sudden there's a reallocation of property that may, trigger some interest at least.
Okay. 7 years is a long time to wait to do tax avoidance, but I take your point.
There are probably better ways of going about that, of course.
Okay.
And very quickly on this companion mixing bowl rule, there are also exceptions for partnership structural changes, operating very similarly to the first rule as well. So in many respects, they are parallel provisions, but with just some minor differences between the two of them.
By the
Um,
way, one thing that I found really interesting about these rules is that there's a step in the shoes concept that's at play here for both of them, because often the contributors might be mom and dad. It could be that the current partners, the kids, are not contributors in the technical sense, but they are donees from their parents, either through their estate or uh, gifts during lifetime. And the applicable regulations make it clear that this pre-contribution gain taint follows the donee or follows a transferee, even though they're not a contributing partner themselves.
yeah,
Another reason why we really need to delve into the sort of history. How did we get to where we are today, both in terms of assets acquired by the partnership and ownership of the partnership interest?
that's right. Yeah, very very important to be mindful of that. Marketable securities are fun to own, certainly, but when they're held in the partnership, there are some additional considerations you have to keep in mind. In my experience, it's not something we run into often, but in theory, it could be, an issue, and it's important to keep in mind. So the general rule of liquidating a partnership, or really just getting a distribution from a partnership overall, is there's not going to be gain recognized on that transaction, except, and a lot of our bread and butter is except for, the general rule, except to the extent that the partner receives money in excess of their outside basis in the partnership. For this purpose, money again is not only cash; it can be kind of changes in partnership liability allocations and also marketable securities. So marketable securities are treated equivalent to cash for this purpose. The rationale presumably being that because they are marketable securities, they are very easily substitutable for cash and should be treated in a similar way. Marketable securities includes not just what we think of as marketable securities in the sense of publicly traded stocks. Certainly, it includes that. It can include certain other types of, actively traded financial instruments. It can include foreign currencies, common trust funds, mutual funds, financial instruments that are readily convertible into money or marketable securities, as well as interests and entities that consist substantially entirely of marketable securities as well. And there are some percentage-based rules there for determining whether and to what extent you fall within that category. So there can be a look through as well. You can't get around these rules by parking marketable securities within a wholly owned subsidiary entity, for example. And so essentially, this exception provides that you treat the marketable securities similar to cash, and you kind of add that to any cash received, and to the extent that exceeds basis, that may trigger gain. To the extent you recognize gain on the distribution of marketable securities, you do get a step up in the basis of those securities to reflect the additional gain recognized, which carries within it a certain internal consistency, if you will, knowing how the code operates. And to the extent that no gain is recognized, the basis of those marketable securities is generally the transferred inside basis, except potentially capped by the partner's outside basis, if for whatever reason the inside and outside basis align perfectly and there's no mismatch. What's interesting is there are exceptions to the exception as well, which again is perhaps typical of how the code operates. So a marketable security won't be treated as money if the security was contributed to the partnership by the partner. So you put marketable securities in, you get the marketable securities out, and generally speaking, there is an anti-stuffing rule that can still, can still bite a partner in those cases. But generally speaking, you don't get hit by this special rule under 731C if you have that type of a scenario.
There's no abuse, right? If the contributor is getting back marketable securities that he or she put in, there's no concern about somebody um, playing games with disproportionate distributions of the assets in that
Exactly.
case. Mhm.
Exactly. There's also an exception to the exception if the partnership is an investment partnership, meaning that it has never engaged in a trade or business, and substantially all of its assets by value have always consisted of certain types of investment type of assets, money, stock, notes, foreign currencies, derivatives, and so forth. And if the partner is a so-called eligible partner, which here means any partner who before the distribution did not contribute to the partnership any property other than investment type assets.
Let me interject a couple of things there, Gene, if I might. Uh,
Mhm.
this is another reason why we really need to understand cold the history of the partnership, right? Uh, it's not uncommon. We're both practicing here in the Midwest. It's not uncommon to bump into, for example, a family entity that used to be a Rust Bowl manufacturer, sold their assets maybe decades ago, and reinvested without liquidating, reinvested in a bucket of marketable securities. So that partnership has been engaged in a trader business, albeit decades ago, and that taint cannot be purged. It's like flypaper. Once you have it, you're stuck with it, and it makes all the difference in the world in our analysis when big chunks of marketable securities are being distributed out.
That's right. Yeah, and that's something that periodically we'll see as well. And in that case, the investment partnership exception won't be availing to the partnership, and you would have to run through the analysis of, are your distributions of cash and marketable securities in excess of basis?
There are other more subtle situations that we run into. Uh, let's say that we find a partnership that doesn't have that, exotic history, but today presents itself as a bucket of marketable securities and rental real estate. Rental real estate isn't necessarily rise to the level of a trader business. The service takes the position, and I think the courts pretty much consistently do as well. If I own a piece of real estate that's subject to a triple net lease, being that I have no management responsibilities whatsoever with respect to that property, I just get a check every month. I'm probably not in a trader business. On the other hand, if I'm actively managing a 12 flat, apartment building in Wrigleyville, um, uh, I'm definitely in a trader business in that case. So sometimes there are some uh, close calls that we have to sort of understand a little better before we know whether or not this particular exception even applies.
That's right. That's right. Um, I think we've, probably indulged in our listeners' patience enough, but there's one more point I want to mention under the marketable securities rules that we've just been discussing. I think at an initial read of the rule perhaps would suggest, well, you look at the fair market value of the securities being distributed and you would treat that as the money being distributed for this purpose. There is a special rule, though, that says that you can reduce the amount of marketable securities that you treat as money, not below zero, but reduce it nonetheless by and I'm kind of quoting from the the statute, but I'll explain it in plain words in just a moment. By the excess of the partner's distributive share of the built-in gain in all of the partnership's marketable securities immediately before the distribution over the partner's distributive share of the built-in gain in all of the partnership's marketable securities immediately after the distribution. The import of this is, let's say, if you have a liquidating distribution, with respect to a partner, that they would disregard the built-in appreciation of those securities in determining the amount of money they get. In other words, for this purpose, cash plus the basis of the marketable securities that they receive would be treated as money for this purpose. If it's not a full liquidation, a partial liquidation, or partial distribution, that would, it would be perhaps somewhere, above whatever the basis is of the securities, but nonetheless, it could still reduce potentially substantially the amount of quote unquote money that the partner is treated as receiving on the distribution.
What's interesting uh, about that exclusion, Gene, is it's almost counterintuitive, but the more built-in gain that you have in the marketable securities, the more comfort you're going to get out of this exclusion. The more of the securities are going to be disregarded as monies. Conversely, the more that the current basis of those securities equals fair market value, you may get very little relief from that. So there's not a hard and fast rule that you can necessarily rely on. Also, even where you're doing proportionate distributions of marketable securities, you could theoretically have numbers such that, or low bases, in the partners, such that even though they get significant relief from this particular exclusion, it's not total relief.
That's right.
uh, right? And then the ultimate, I've seen this, some years ago, uh, consulted with some folks who had facts somewhat similar to this. So let's say son and daughter are the remaining partners. Mom and dad have passed away. The partnership owns two types of assets: rental real estate, clearly trader business real estate, worth $2.5 million. And let's say that the inside basis, is 500,000 of that real estate. On the other hand, they own $2.5 million of marketable securities with, let's assume, an identical basis, $500,000. And son and daughter say, this is going to be real, we're going to make this real easy. Son wants to take the real estate, daughter wants to take the marketable securities. What could be wrong with that? We're getting exactly the same value. We're getting exactly the same basis, let's assume. Let's assume their outside basis is also $500,000 each. So, kind of what could go wrong? And what could go wrong is the exclusion that you had mentioned, Gene, of looking at the partner's share of a built-in gain in the marketable securities before and after the distribution. For daughter, in this case, the built-in gain is $2 million in total. Her share is $1 million of that. So she gets $1 million of relief, right, by the exclusion. But she still has uh, uh, $1.5 million of marketable securities that are treated like cash, as against her $500,000 basis. So she's got $1 million gain. And son, her brother, has a completely tax deferred situation. Let's assume there's no depreciation recapture in the rental real estate. He can take that real estate. Now he takes a basis in that real estate of only $500,000, uh, uh, and he'll recognize gain if and when he sells it. But he has no immediate tax situation. That would be a really bad day because, in this particular case, daughter's expectation was, hey, I like the portfolio. It's well diversified. I plan to hold on to it. My estate planner told me if I hold on to it till I die, my heirs will never pay the tax. Well, that's generally true, but because you're getting it through this partnership, you're triggering most of the gain, in this particular example. If you were to have gone forward with this 50-50 split in a disproportionate way, that's really, to my mind, that's kind of one of the worst. That's an example of one of the worst traps that we could possibly imagine in liquidating a partnership in the context of what appears on its face to be a very plain vanilla uh, situation that should not generate tax consequences for anybody, but it does.
And unfortunately, it's all too common in the closely held context because it's, for whatever reason, you may have, siblings who want to go their separate ways. And there's often a desire to not do pro rata distributions, especially when you have different types of assets, let's say real estate, marketable securities, maybe a business, operating business or something like that. One of the siblings may be interested in taking one or the other. And you divide up the assets that way, and unfortunately, as you observed, you can easily trigger gain on this. Which I mean, to some degree, it's a question of timing, unless you're planning on holding the securities until you pass, and then there's a step up in basis. But ultimately, it's a question of timing because you do get a step up in the basis if you recognize gain on the distribution of the property from the partnership, but that's only immaterial to those who would then turn around and sell the assets shortly after, as opposed to those who may want to hold on to the assets for some period of time. If that's the case, then yeah, there's essentially tax that they have to pay without kind of the benefit of having the cash in hand.
Absolutely. Well, Gene, I think it's mission accomplished in terms of at least some of the main traps that we wanted to point out to folks in the liquidation of a partnership or any entity taxed as a partnership. Any further or final comments
No,
before we sign off?
I think we hit on all the fun and salient points.
Who says tax law isn't fun, Gene? Uh, Anyhow, we appreciate your tuning in. Again, you can uh, correspond with us at tax stuff at ASF. Excuse me. Let's try that again on you. You can reach us at tax stuff at AFS. That's Alpha Frank Sam Law.com with any questions that you might have, or if there are topics that you'd love for us to cover in the future. We'd be happy to hear from you. Uh, That being the case, until next time, we'll sign off for now. And Gene, have a great rest of your day.
You too, Bob.
All right.